Hi there and welcome to today's episode. Hope you enjoyed watching the series on finance and everything that's got to do with financial statements and reporting. So today we're really excited. I want to share with you today's episode on how to understand your balance sheet. Now, why is it important? It's important to make sure that every part of the business is running super efficiently, and most importantly, running streamlined for the business itself. So in this series, we've had things like your profit and loss statement, your cash flow statement. Today's episode is a balance sheet. We've also spoken about your P&L, right? Your profit and loss. So today, there's no different. This is one of the major important key parts of your business finances called the balance sheet. So I'm hoping you get a lot out of it today and you get a really good basic understanding of what the balance sheet is and what it's for. All right, so let's get into it. So I've written here just a quick sort of comment around it, but the balance sheet represents a financial snapshot of what the company owns and owes at a particular point in time. So, and this could, typically happen at the end of a month or a quarter. It's essentially the net worth statement for the company, right? And as you'll see on the next slide, the left or the top side of the balance sheet lists everything that the company owns, which are its assets, also known as debits, and the right or lower side lists what the company's claims against the company, which is called its liability or credits, and shareholder equity. Now, liabilities may not seem like credits to you, but it's not really a typo, right? In accounting, the lingo is a credit is a loan. So think of it like that, right? So a credit brings cash in that, the firm can use to purchase an asset. However, this credit is still a liability. Why? Because it's a debt and it's got to be paid back at a later date. So in other words, if you've got a loan that you've bought in, technically that's still it's ultimately still a liability or a credit because it's a credit from somebody else. And really, it's a liability or a debt that needs to be paid back. Yeah. So we use the assets and liabilities as our main terms. Don't worry too much about the keeping that straight. But it's literally called the balance sheet because each side it must equal the other. So the assets equal the liabilities plus the shareholder equity. In other words, whatever assets aren't being used to pay off the liabilities belong to the shareholders. Now, let me show you what I mean. So I've just broken it down so everybody understands it more. So when you want to understand a balance sheet, there's assets, liabilities, and then shareholders' equity. So let's start with the assets. So the assets are, items of value that the company owns. One of these could be maybe the premises that you're in. So the major components that make up the assets of balance sheet are things like current assets, fixed assets, investment, and intangibles. So you may have another property that the company is not in, but it's an asset because you're getting, income from there. So current assets includes things like cash, obviously, or cash equivalent, like bank accounts, securities. It could be things like gold. Some people have that as an asset. It could be shares, anything that becomes, that you can turn into liquid cash if you want to think of it like that. Yeah, accounts receivable and inventory. So let's say if there's a customer that owes you money, and that's guaranteed that that's coming in. Well, obviously that's an account receivable, so you've got that. And let's say if you've got inventory in a warehouse, that's counted, as an asset as well. Other assets include investment like stocks, bonds, as we just spoke about, fixed asset like real estate that I just spoke to you about, vehicles, certain things like copyright. So if you're, Kentucky Fried, as an example, that's definitely an asset. That's a copyright asset. Trademarks that you may have, patents, right? Some levels of company goodwill, depending on, like saying if it's, Starbucks or Kmart or any of these, that's definitely an asset. It's the name, it's the brand that goes around that, right? But they're also called intangibles as well, right? Now, what do you value that company at? Obviously, the goodwill. I'm figuring that, companies like Apple have got a massive amount of, goodwill, and that the name itself is a massive asset. Yeah. Now, on the other hand, which is a liability. So I want you to think about the liabilities, and then on the other hand, it's a liability. So think of it almost like an IOU. I wanted to make it easier that you kind of get that, right? Together, they represent the total cash value of what the company owes to the other entity. So liabilities aren't necessarily a bad thing, right? After all, right, companies have to spend money to make money, right? So they only become a problem when the company consistently keeps on spending more than it's earning and has no clear or viable strategy to reduce that trend, right, or to reduce that way of doing business. So liabilities include things like accounts payable, long-term debt, mortgages, lease payments, or any of those type of things are the liabilities. So you want to go the assets minus liabilities, and then you've got a particular balance that's about to come out from there. Now, I want to then add also the shareholder equity, and I'm going to take you to the next slide where we break down, if you had to print off a report, you'll see how that works on the next slide. So let's say we subtract the total liabilities from the total assets, and you end up with the company's net worth, also known as the shareholder equity, right? So in other words, the shareholders' ownership then stake, after all the debts are paid. So this is what's left after the debt's paid. That's why stocks are also called equity. Why? Because in a fire sale, I can sell, I don't know, if I've got, sunglasses as an example, in a fire sale, if I needed to get rid of them quickly, there's still an asset there. Sure, it's going to be, I'm going to reduce the margin of the asset itself just to get rid of it, but still it becomes, what I can sell. So you've got an asset minus the liability, whatever it's cost us, and then you're good to go. So, and then they ultimately determine how much each share receives in dividends. So let's say if you've got, $2 in asset, $1 in liability, that's $1. And then, that you've got two shareholders, as an example, 50 cents go to each if they're an equal shareholder. But I don't want you to get sort of too caught up in that. I just want you to understand more around the balance sheet. Okay, so let's have a look at this. So this is just a company, right? March 31st. As of March 31st, the company has the current assets, as an example, $4,434,000 in cash and cash equivalents. Their accounts receivable is owed $5 million. Their inventory is about $7.6 million. Other assets are 4.215. This could be cars, it could be other inventory, it could be maybe buildings, whatever it may be. So they've got roughly $22 million literally in assets. Now, they've got plant equipment of about 18 million, right? This is a reasonably big company. Goodwill and intangible assets, right? So they've got a pretty strong name. I don't know what the company is, but they're a pretty strong name as an example. $87 million just in that. Other non-current assets, $4 million. So roughly it's about $132,295,000. Yep. So as you can see, all they're doing is they're just adding up all their assets, any of the goodwill and tangibles. Now, your company may not be that. Maybe it's, $132,000, right? And, take some of the zeros off here. But nevertheless, you've got, money that's cash, people that owe money, inventory that you may have in stock, any other assets, and there you've got those figures there. Now, look at the liabilities. So the liabilities are $5 million that they owe, $7 million in other current liabilities. Long-term debt, right, is 18 million. So this could be from a supplier. It could be, stock that they're getting through. It could be, other, companies that they own. There's a lot of different things. There's a tax payable. It's very important to make sure that a tax is a liability that you pay as well. So you can see this. So the current total liabilities are $32,829,000 if I add these up, plus the long-term debt is about $20 million. Other liabilities are about $18 million. So see, it's $71,620,000. So if you look at then that figure minus this figure, if I add 71 and 60,000, right, these numbers here, it roughly equals about 132,395 million. So can you see that total asset there should equal the total liabilities and equity of about $132 million. So technically, if I take all the assets minus the liabilities, I've got $60 million that we can share up, divvy up within the shareholders' equity, minus obviously some tax debt or whatever may come from there. But as you can see, that the total assets equals the total liabilities and equities put together. See, they're the same figures. Now, I've got three critical numbers I think that we need to look at. Number one, assets is what we own, so cash, accounts, inventory, building. Liability, what we owe, accounts payable, tax, payable, loans. And then owner's equity is the company's net worth. Okay, so they're important components that you need to look at within that. Now, so here's the thing, right? So let me just come back to this slide here. So if we look at this slide as an example, right, and these two components, if we look at this, you don't want to be able to have that your liabilities are much higher than the assets all the time, or else we're going to have a negative figure. So we owe more than what we're making. So something that you need to really look out for as a business owner is to make sure that you're not overbuying stock that then you can't service it, or you haven't paid debt for a long time and you're not looking at the debt and it looks like you're making money here, or if you've got a lot of assets in, let's say, cash and cash equivalents, or you've got money coming in but you forgot to remember that there's a big tax debt, and then that balance doesn't balance out. That means that you've got a lot more debt than you have in, you've got a lot more liability than you actually have in assets. And I see this a lot with business owners, that they, count the stock that they have, but then they forget to look at that they owe money on that stock. So it's a debt or a liability in accounts payable. So what they do is they start robbing Peter to pay Paul. So they get money in through here in the accounts receivable. They've owed money in the accounts, in the liabilities in the accounts payable. They haven't paid that off. They use this to buy more stock, and sooner or later this liability starts to add up. The long-term debt on the money starts to add up, interest, everything else, and then they don't pay tax. So you really want to make sure that you're not doing that whatsoever. All right, I hope that was a good understanding. If you want to know obviously more, drop us an email at ask@nickpsaila.com, and we'll be more than helpful to answer any questions that you may have. All right, I hope you're enjoying this series. I definitely am. It's business basics that all of us could have a refresher on, regardless of where you are in business. So I want to make sure you're getting a lot out of these and having fun in the same time. All right, I look forward to seeing you on the next episode.